Hey everyone, welcome back to Corporate Decoder. This week we are diving deep into Therapeutics Inc.'s latest financial report, and let me tell you if you are interested in how clinical stage biotech companies operate, and especially one that is navigating a huge potential merger, oh boy you are in for a treat. Before we dive in, if you like getting these unfiltered financial insights, make sure you are subscribed. We also have a Discord community linked in the description if you want to chat more about these filings. So buckle up because things at Akero Therapeutics got really interesting around October last year with a deal that could completely change their future. They announced they entered into a crucial agreement called a merger agreement. Basically, a much bigger company, Novo Nordisk, plans to buy Akero Therapeutics. This is a huge deal, and it colours everything in this report. Imagine a big fish deciding to swallow a smaller but promising fish. That is kind of what is happening here. Let's jump straight into the numbers, starting with their balance sheet. As of the 30th of September 2025, Akero had about $176 million in cash and cash equivalents. That might sound like a lot, but compare that to over $340 million at the end of 2024, and you see their cash pile has been shrinking. They definitely have investments, with over $813 million in short and long-term marketable securities, which are basically like super safe short-term investments for their cash. Overall, their total assets grew to just over $1 billion by September 2025, up from about $825 million at the end of 2024. This growth is largely due to their significant investments in marketable securities. Looking at their liabilities, accounts payable were around $20 million in September 2025, up from about $9 million at the end of 2024. This means they owe more to their suppliers, which is pretty normal if they are ramping up activities. A big change here is the loan payable. At the end of 2024, they had about $35 million in long-term loans, but by September 2025, this number is zero. They paid off all their long-term debt. That is a good sign for financial health, especially with a potential buyout. Their common stock is still recorded at a very tiny par value, but the amount shows how many shares are out there. By the 30th of September 2025, they had over 80 million shares outstanding compared to about 72 million at the end of 2024. This increase comes from new stock issuances, which we'll talk about later. Additional paid-in capital, which is basically the extra money investors paid over the par value of stock, jumped significantly to over $2 billion by September 2025, up from around $1.5 billion at the end of 2024. This huge increase is mostly from selling more stock. And now for the number that shows they are still a development stage company, the accumulated deficit. By September 2025, it had ballooned to over $1 billion. That is a lot of red ink, but typical for a biotech company in their situation. Now let's look at how they are spending money and their performance over the last few periods. The big story in their operations is always research and development. For the 3 months ending the 30th of September 2025, they spent nearly $79 million on R&D, up from about $72 million in the same period in 2024. That is about a 9% increase. For the 9 months ending the 30th of September 2025, R&D expenses were over $217 million, a significant jump of $39.5 million or 22% higher than the previous year. This shows they are heavily investing in developing their main drug candidate, efruxifermin. General and administrative expenses, which cover things like management salaries and legal costs, also went up for the 3 months. They were about $11.4 million, a 20% increase from 2024. Over 9 months, they were over $34 million, up 17%. This rise is mainly due to more staff and higher stock-based compensation expenses. As expected for a company in this stage, their net loss increased. For the 3 months ending the 30th of September 2025, the net loss was over $81 million compared to about $72 million in 2024. Over 9 months, the net loss was over $222 million, a big jump from about $182 million in the prior period. Remember, this is normal for a company pouring money into drug development. A notable one-time event is the loss on extinguishment of loan payable of about $1.6 million in the first 9 months of 2025. This relates to them paying off that loan we saw earlier. On the plus side, their interest and other income rose to over $11 million for the quarter and over $34 million for the 9 months, mainly because they have more cash and investments from their stock sales. Now let's look at how that money flowed through the company's equity. This table shows the big money coming in. In January 2025, they had a huge influx of cash from a follow-on offering, bringing in over $378 million. This is a major event. They also sold over 380,000 shares under their ATM selling agreement, adding about $10 million. Expenses related to stock compensation continue to rise, reflecting the equity grants to employees, which is standard practice to attract and retain talent in this industry. The net loss, as we saw, is a consistent part of their story. By the end of September 2025, their total stockholders' equity was just over $957 million. This is a substantial increase from about $750 million at the end of 2024, primarily driven by those successful stock offerings. Looking at the cash flow statement, it confirms what we saw in the income statement. They used over $183 million for operating activities in the first 9 months of 2025. This is largely due to their net loss, offset by non-cash items like stock-based compensation. Their investing activities show they purchased over $732 million in marketable securities, while receiving about $386 million from maturities. This means they are actively managing their large cash reserves. The financing activities section is huge. For the first 9 months of 2025, they brought in over $364 million, thanks to that big stock offering and exercise of stock options. This inflow is partially offset by paying off the $37 million loan. Now about that mega deal. The acquisition by Novo Nordisk is everything right now. If it goes through, Akero stock will stop being publicly traded, and shareholders will get a nice payday of $54 in cash per S-share, plus an extra potential $6 per S-share based on certain milestones. This deal is subject to all sorts of approvals, including regulatory ones from the Hart-Scott-Rodino Act, which is a big antitrust review, and also approval from Akero's own shareholders. They expect it to close by year end. Of course, no deal like this is guaranteed. The risk section spells this out clearly. There is the risk that the Novo Nordisk deal might not happen at all, or might be delayed. This uncertainty alone can hurt the company. They also face standard biotech risks, patient enrollment challenges in clinical trials, competition from other companies, potential failures or delays in their clinical trials, manufacturing issues, and that whole long, unpredictable process of getting drugs approved by regulators like the FDA. They specifically call out difficulties in finding patients for their MASH trials and competition for those patients. Plus, they mention geopolitical tensions could impact sites in places like India and Turkey. Competition is fierce. They list a whole bunch of big-name pharma and biotech companies that are also working on similar MASH treatments. This means Akero has to be not just good, but better and faster. This is a critical point. Akero is putting all its eggs in the efruxifermin or EFX basket. If EFX doesn't work out, the company's future as an independent entity looks very bleak. The financial reality is stark. They've lost a ton of money since they started, and they expect to keep losing money for a while. This is why funding is always a huge issue for these companies. And that leads directly to their financial health. At the end of September 2025, they had about $988 million in cash and short-term investments. The company believes this is enough to keep the lights on for at least 12 months from the report's issue date. But if that Novo Nordisk deal falls through, they'll need a lot more money. And there is no guarantee they'll get it on good terms, or at all. Interestingly, their investment income is growing. For the 9 months ending September 2025, that income was over $34 million. While it doesn't offset their massive operating losses, it is a nice cushion from smart cash management. The net loss per S-share is also a hefty sum. For those 9 months, it is a loss of $2.76 per S-share, which sounds like a lot, but it reflects the overall losses spread across all outstanding shares. That $1.6 million loss on extinguishing debt is a clear sign they paid off their loans, which is a positive, even with the associated cost. Their risk factors are extensive as expected, but the Novo Nordisk deal looms large. They detail how the deal's uncertainty can affect employee morale, business relationships, and frankly, diverts management's attention from day-to-day operations. They also had a securities lawsuit filed against them related to their Phase 2b symmetry study, but the court dismissed it twice, although an appeal is pending. This dependence on EFX is really the core of Akero's story. All their hopes, all their funding, all their future rests on this one drug working. And that leads us to the biggest question: will the Novo Nordisk deal go through? If it does, it is likely a very good outcome for shareholders. If it doesn't, Akero faces a much tougher road, needing significant new funding to continue its drug development. So, what is my take on Akero Therapeutics? They're a classic development stage biotech company at a critical juncture. Their biggest strength is clearly the potential of efruxifermin, their lead drug for MASH, and the very attractive acquisition offer from Novo Nordisk. This offer provides a potential lucrative exit for investors. However, the biggest risk is the deal falling through. If that happens, They face immense pressure to secure substantial funding. Their drug development pipeline is heavily reliant on EFX, and the competition in the MASH space is intense. The financial numbers show a company burning through cash, but operating with a significant investment portfolio, a testament to their fundraising success. But without that Novo Nordisk deal, that cash pile is their lifeline, and it needs to stretch far enough to get EFX approved, or they'll be back in the fundraising trenches, potentially with much less favourable terms. What do you think about this deal and Akero's future? Let me know your thoughts in the comments below, if this deep dive was valuable. Please hit that like button and subscribe for more corporate financial decoded, and don't forget to join our Discord community linked in the description. Thanks for watching, see you next time.